Ladies and gentlemen, listen very carefully. For decades, people have chased hype, trends, and shiny new toys in the market. Crypto, tech bubbles, meme stocks, you name it. And most of them, they end the same way. Someone gets rich and someone gets crushed. But today, I'm not here to sell you a fantasy. I'm here to talk about discipline, protection, and real money. Because while everyone is distracted, smart capital is moving quietly into one place, a place that has survived wars, collapses, inflation, and every bad government decision in history. That place is gold. And let me be absolutely clear, gold is not emotional, it's not political, and it doesn't care about your opinion. It responds to fear, debt, and reckless spending. And right now, the world has all three. So the question isn't if gold will surge. The question is, will you be positioned before it does, or will you watch from the sidelines like everyone else? Let's talk about why gold is about to move like never before, and why ignoring it could be the most expensive mistake you make. Global debt is exploding, and this is not a headline designed to scare you. It's a mathematical reality. Governments around the world are spending far more than they earn year after year with no credible plan to stop. The United States alone carries debt so large that the interest payments are starting to rival defense budgets. Europe isn't far behind, and emerging markets are borrowing aggressively just to keep their economies functioning. Debt has become the default solution to every political problem because raising taxes is unpopular and cutting spending is politically suicidal. So leaders do what they always do. They borrow, print, and delay the consequences. Here's the uncomfortable truth. Debt doesn't disappear. It gets rolled over, inflated away, or it detonates. When debt levels grow faster than economic growth, something has to give. Governments cannot simply grow their way out anymore because productivity is slowing, populations are aging, and entitlement obligations are exploding. This means future promises are being paid with money that does not yet exist. The only tool left in the toolbox is currency debasement, printing more money to service old obligations. That might feel painless at first, but it quietly steals purchasing power from everyone holding cash. This is where gold enters the conversation, not as a speculative bet, but as an insurance policy. Gold does not depend on a government's promise to pay. It doesn't rely on a central bank's credibility or a politician's re-election campaign. It has no counterparty risk. When currencies are diluted to manage unpayable debt, gold holds its value because it cannot be printed, manipulated, or voted into existence. That scarcity is precisely why it has functioned as a store of value for thousands of years. History is brutally consistent on this point. Every time debt reaches unsustainable levels, policymakers choose inflation over default. It's quieter, it's easier to hide, and most people don't understand it until the damage is done. Savings erode, wages lag behind prices, and retirees feel the pain first. During these periods, gold doesn't explode because of hype. It rises because confidence in paper money falls. Investors don't buy gold because they love it. They buy it because they no longer trust the system backing their currency. What makes this cycle different is the scale. Global debt today is larger, more interconnected, and more fragile than at any point in modern history. A shock in one region ripples instantly across markets. Central banks are trapped, raise rates too much, and the debt collapses keep rates low, and inflation eats the economy alive. There is no painless option left. In that environment, capital looks for safety, not returns, and gold becomes a strategic asset rather than a speculative one. Owning gold is not about predicting the end of the world. It's about acknowledging that debt-fueled systems eventually demand a price, and that price is almost always paid through currency devaluation. Gold doesn't solve the problem, but it protects against it by standing outside the system entirely. Inflation is not a temporary inconvenience, despite how often that word has been used to calm markets and voters. It is a structural outcome of years of monetary excess, supply chain fragility, and policy decisions that prioritize short-term stability over long-term discipline. When trillions of dollars are injected into the system, they don't simply vanish once the crisis headlines fade. That money circulates, embeds itself into prices, wages, and expectations, and permanently shifts the cost structure of the economy. Calling inflation transitory doesn't reverse the damage, it only delays public recognition of what's actually happening. The real danger of inflation is not just higher prices, it's the silent destruction of purchasing power. Cash sitting in a bank account loses value every single day. Inflation runs hotter than interest rates. Even when inflation slows, it rarely retreats to previous levels. Prices don't come down, they reset higher. That means consumers are forced to accept a new normal where essentials cost more, savings buy less, and long-term planning becomes harder. For working families, this feels like running faster just to stay in the same place. For investors, it's a warning that traditional assumptions about money no longer apply. Central banks are caught in a credibility trap. If they raise interest rates aggressively to crush inflation, they risk breaking debt-heavy economies and triggering recessions. If they pause or reverse course too early, inflation reignites and expectations become unanchored. Once people believe prices will keep rising, behavior changes. Spending accelerates, saving declines, and inflation feeds on itself. This psychological component is extremely difficult to undo, and history shows that central banks often lose control before they regain it. Inflation also distorts markets by rewarding debt and punishing discipline. Borrowers benefit because they repay loans with weaker currency, while savers and fixed income earners lose real value. This imbalance pushes people into riskier assets not because they want to speculate, but because they're trying to survive. When safe instruments no longer preserve wealth, capital is forced further out the risk curve, inflating bubbles and increasing systemic fragility. In this environment, hard assets become essential, not optional. Gold stands out because it has no yield to manipulate and no issuer to trust. Its value is derived from policy decisions or earnings forecasts, but from its ability to retain purchasing power when currencies fail to do so. As inflation eats away at fiat money, gold acts as a measuring stick, revealing how much value paper currency has actually lost. This is why gold often rises even when growth is weak or markets are volatile. It reflects monetary reality, not optimism. What makes the current inflationary cycle especially dangerous is its persistence. Energy costs, labor shortages, geopolitical tensions, and reshoring of supply chains all point towards structurally higher prices. These forces don't resolve in quarters, they unfold over years. That means the erosion of purchasing power is not a short storm to wait out, but a long-term climate shift that demands protection rather than patience. Central banks are often described as the smartest institutions in the financial system, not because they predict the future perfectly, but because they see risk before it shows up in headlines. When they move, they do it quietly, strategically, and with long time horizons. Over the past several years, one trend has become impossible to ignore. Central banks across the world are accumulating gold at a pace not seen in decades. This is not emotional buying, and it is not speculation. It is a calculated response to a shifting global financial order. At the core of this behavior is trust, or more accurately, the erosion of it. For decades, the global system has revolved around a small number of reserve currencies, with the US dollar at the center. That system depends on stability, predictable policy, and confidence that debt obligations will be honored without excessive currency dilution. As deficits grow, sanctions are weaponized, and monetary policy becomes increasingly political, that confidence weakens. Central banks are responding by diversifying away from assets that depend on another country's promises and into assets that stand alone. Gold serves a unique role on a central bank balance sheet because it is no one else's liability. Bonds depend on governments. Currencies depend on central banks. Gold depends on nothing. It cannot be frozen, defaulted on, or printed into excess. When geopolitical tensions rise or financial systems come under stress, gold becomes a neutral reserve asset that carries no political allegiance. This neutrality is becoming more valuable in a world that is fragmenting rather than integrating. Another critical factor driving central bank gold purchases is currency risk. When a nation holds reserves in foreign currencies, it is exposed to policy decisions made outside its control. interest rate changes, inflation targets, and fiscal priorities in another country directly affect the real value of those reserves. Gold removes that exposure. Its value is global, not domestic, and it reflects real purchasing power rather than political objectives. This is why both developed and emerging market central banks are increasing their allocations, even when it draws little public attention. What's especially telling is the consistency of these purchases during periods of price weakness. Central banks are not chasing momentum, they are building positions. They buy when prices dip and continue accumulating regardless of short-term volatility. This behavior mirrors how long-term institutional capital operates when it is preparing for systemic risk rather than quarterly performance. It signals concern not about a single crisis, but about the durability of the current monetary framework. Retail investors often look for signals in headlines, earnings reports, or social media sentiment. Central banks look at balance sheet sustainability, reserve safety, and long-term stability. When those institutions choose gold over higher yielding assets, it reveals a preference for preservation over performance. That choice carries weight because it reflects what the system's ultimate backstops are doing with their own capital. Gold buying at this scale is not a vote against growth or innovation, it is a hedge against disorder. It suggests that the institutions tasked with protecting national wealth are preparing for a future where volatility, currency competition, and financial fragmentation are more common. When the most powerful monetary authorities in the world quietly agree on one asset, it's not a coincidence. It's a signal that trust in paper promises is being replaced by trust in something tangible. Currencies are built on confidence, not permanence. Every fiat currency in history has followed the same basic pattern. It is introduced to facilitate trade, trusted because of stability, expanded to solve political and economic problems, and eventually weakened by overuse. No government sets out to destroy its currency, but every government faces pressure to spend more than it earns, especially during crises. Over time, that pressure erodes discipline, and the value of the currency reflects it. Gold exists outside this cycle, which is why it survives while currencies fade. When a currency fails, it rarely happens overnight. It weakens gradually through inflation, devaluation, and loss of purchasing power. People don't wake up one morning to find their money worthless. They notice it when everyday necessities cost more, savings no longer stretch as far, and long-term planning becomes impossible. Governments often frame this as growth or stimulus, but the effect on the average person is the same. Their money buys less. History offers countless examples, from ancient empires to modern economies, all showing that fiat money eventually pays the price for political convenience. Gold, by contra, has never required trust in an issuing authority. It doesn't rely on laws, central banks, or military power to maintain value. Its worth comes from scarcity, durability, and universal acceptance. An ounce of gold purchased the same fundamental goods centuries ago that it does today, not because gold became more valuable, but because currencies became weaker. This is why gold is often misunderstood. It doesn't grow wealth in the traditional sense, it preserves it when money fails to do so. What makes gold unique is its independence from policy decisions. When interest rates are manipulated, gold remains unchanged. When governments change tax codes, spending priorities, or monetary targets, gold is unaffected. It sits quietly, responding only to the collective loss or gain of confidence in currency systems. When confidence falls, gold rises not out of speculation, but as a reflection of reality. It becomes the measuring stick against which paper money is judged. Throughout history, during wars, hyperinflation, and financial collapses, gold retained its purchasing power when currencies did not. In Germany during the 1920s, in Argentina during repeated devaluations, in countless emerging markets, those who held gold preserved wealth while others watched savings evaporate. These are not isolated stories, they are recurring outcomes of the same monetary behavior. Gold doesn't prevent crises, but it outlives them. In modern times, currencies are under even greater strain. Digital money can be created instantly, deficits are measured in trillions, and political incentives favor short-term relief over long-term stability. This accelerates the historical pattern rather than replacing it. While technology has changed the speed of transactions, It has not changed human behavior or political reality. The temptation to solve problems by printing money remains constant. Goal. D's survival is not based on nostalgia or tradition, it is based on function. It acts as a store of value precisely because it is immune to the forces that undermine currencies. As long as governments continue to rely on debt, inflation, and monetary expansion to manage economies, currencies will continue to weaken over time. Gold does not compete with currencies in daily use, but it quietly outlasts them, preserving value when paper promises inevitably lose credibility. Geopolitical chaos has always had a predictable effect on capital flows, even when the headlines feel unprecedented. Wars, trade conflicts, sanctions, and political instability create uncertainty, and uncertainty changes behavior. Investors don't need to agree on outcomes to agree on risk. When the future becomes harder to model, money stops chasing growth and starts seeking safety. This shift happens quickly and often before the full consequences of the conflict are understood. Capital moves away from assets that depend on stability and toward assets that hold value regardless of who wins or loses. Modern geopolitics is especially volatile because conflicts are no longer isolated. Supply chains are global, energy markets are interconnected, and financial systems are tightly linked. A disruption in one region sends shockwaves across commodities, currencies, and equity markets worldwide. Sanctions can freeze reserves, disrupt trade, and destabilize entire economies overnight. This has changed how governments and investors think about risk. Political decisions now carry immediate financial consequences, and assets that were once considered safe can become liabilities without warning. Gold benefits from this environment because it is politically neutral. It does not belong to any government, alliance, or economic bloc. It cannot be sanctioned, defaulted on, or devalued by decree. When geopolitical tension, NS rise, trust in cross-border financial arrangements weakens, investors begin to question whether assets held in foreign jurisdictions are truly safe. Gold removes that uncertainty by existing outside the political system entirely. Its value is recognized globally, regardless of shifting alliances or ideological divides. Energy conflicts, in particular, amplify gold's appeal. When energy prices spike due to war or instability, inflation follows. Higher energy costs ripple through transportation, manufacturing, and food production, pushing prices up across the economy. Central banks are then forced into impossible choices between fighting inflation and protecting growth. This policy paralysis increases market volatility and undermines confidence in currencies. Gold responds not to the conflict itself, but to the inflationary and monetary consequences that follow. Geopolitical risk also drives demand from governments, not just investors. Nations facing uncertainty seek to strengthen their reserves with assets that cannot be controlled by adversaries. This strategic demand adds a powerful layer of support to gold prices. Speculative flows, this buying is deliberate and long-term. It reflects preparation rather than panic. When multiple governments act on the same concern, it signals that instability is not viewed as temporary. For investors, the key issue is asymmetry. Geopolitical events are difficult to predict but easy to underestimate. Markets often price in calm until chaos forces a repricing. Gold acts as a hedge against this imbalance. It may appear unproductive during peaceful periods, but its value becomes clear when volatility spikes. It doesn't require escalation to perform. It only requires uncertainty. As the global order becomes more fragmented, with rising nationalism, trade realignments, and strategic rivalries, geopolitical risk becomes a constant rather than an exception. In this environment, assets tied to growth projections and political stability become more vulnerable. Gold thrives not because it benefits from conflict, but because it protects against the loss of confidence that conflict creates. Capital has always followed fear into hard assets, and history shows that when uncertainty dominates the landscape, gold becomes a destination rather than an afterthought. Smart money has never moved with the crowd, and it never will. Institutional investors, High net worth individuals and seasoned capital allocators operate on information, probabilities, and risk management, not emotion. They enter positions quietly, early, and often when the narrative is still boring or uncomfortable. By the time an asset becomes a headline, most of the upside has already been absorbed. Retail investors, on the other hand, are conditioned to react. They wait for confirmation, for social proof, for excitement, and that delay usually comes at a cost. Markets are driven by cycles of fear and greed, and retail behavior consistently appears at the most vulnerable points of those cycles. When prices are rising and stories are everywhere, confidence feels justified. When prices are falling and silence dominates, fear takes over. Smart money understands this pattern and uses it. Accumulation happens during periods of disinterest, not euphoria. Assets are built into portfolios when they are ignored, undervalued, or misunderstood long before momentum traders arrive. Gold is a textbook example of this behavior. It rarely attracts attention when conditions are calm and markets are optimistic. During those times, it's labeled outdated, unproductive, or irrelevant. That is precisely when long-term capital begins to build positions. Institutions don't buy gold because it's exciting. They buy it because it reduces portfolio risk before risk becomes obvious. They don't wait for inflation to peak, currencies to weaken, or crises to erupt. They position ahead of those outcomes because by the time they are visible, protection becomes expensive. Retail investors tend to approach gold defensively and emotionally. They rush in during market crashes, currency scares, or after sharp price moves, often buying at elevated levels. This behavior isn't irrational, it's human, but it highlights the difference between preparation and reaction. Smart money treats gold as a strategic allocation, not a panic button. It's integrated into portfolios quietly, incrementally, and without drama. The same pattern plays out across all asset classes, but it's especially pronounced with gold because its value is tied to macro forces rather than growth narratives. Debt accumulation, monetary expansion, and geopolitical risk develop slowly, then accelerate suddenly. Those watching indicators rather than headlines see the shift coming. Those watching news often arrive late. By the time gold is being discussed on mainstream platforms as a necessity, institutional allocations are already established. Another critical difference is time horizon. Smart money thinks in years and decades. Retail investors often think in weeks and months. Gold doesn't reward impatience, it rewards positioning. Its biggest moves tend to occur after long periods of consolidation, when confidence in other assets begins to crack. Those already positioned benefit from the repricing. Those who wait are forced to decide under pressure. The dynamic creates a recurring transfer of value from late entrants to early allocators. It's not malicious, it's structural. Markets reward foresight and punish delay. Gold doesn't announce when it's about to move. It responds to shifts in confidence, liquidity, and trust that build beneath the surface. Smart money understands this and acts accordingly, while retail investors often respond only after those forces become impossible to ignore.